Okay, so we're looking at the potential advantages of using a members voluntary liquidation, or MVL, when closing down a business. An MVL is essentially the liquidation of a solvent business. Just to give you a brief overview, there were changes to legislation in 2012, which means that in order to just a final distribution to be made of funds in excess of £25,000 requires the use of an MVL if those funds are to be treated as capital income rather than personal income. The advantage of capital income receipt is the tax on capital receipts of 10% rather than the funds being classed as personal income, which is taxed at 20%, or perhaps 40% if you're a higher rate taxpayer. The £25,000 is per company and not per shareholder, and there is also a cliff edge situation, meaning that if the funds are in excess of £25,000, i.e. £25,000 and a penny, then the whole of the funds cannot be treated as capital unless, as I say, it's through the MVL process. Clearly the benefit then is in relation to the tax implications of receiving funds as capital as opposed to personal. As I've touched on earlier, 10% compared to the up to 40%. As a consequence of that, each case must be considered carefully on its own merit, and the shareholder's own personal tax position will be relevant when you take into account the tax savings compared to the cost of actually using the MVL process. We're not tax advisors. We do not purport to be tax advisors. We work very closely with accountants in order to ensure that the MVL process is the right one for you. Just putting the tax benefits aside for a moment, there are other benefits to using the MVL process. The first one would be that all the directors' obligations when dealing with the company's affairs and winding it down are dealt with by the liquidator, and so it is therefore becomes the duty of the liquidator to ensure that all the affairs are dealt with in the proper manner. It's usually a relatively low cost. It's going to depend on the size and complexity of the case, but you would normally be looking anywhere between sort of £2,000 and £4,500 plus VAT. If the company is VAT registered, of course, the VAT can be recovered. In order to expedite the process and reduce cost, it's helpful if before the company actually goes into an MVL and a liquidator is instructed that all the company's tax affairs have been brought up to date, all the accounts have been filed, and the final returns have been filed, and of course all creditors have been dealt with and paid in full. The other advantage with using the MVL process is that if the company has assets that remain other than cash, those assets can also be distributed by the liquidator to the shareholders as long as the shareholders have agreed via a special resolution that for a distribution in specie. The risks to consider, particularly for the directors, is that an MVL is only available for solvent businesses, and all liabilities have to be paid within a 12-month period. It's therefore important to ensure that consideration is given to any prospective or contingent liabilities, such as finance agreements, leases, or of course employee claims for redundancy, etc. The directors actually swear a statutory declaration of solvency, and it's therefore their duty to ensure that that declaration is correct. If it transpires that it is proved to be incorrect, the directors can face serious sanctions, including fines and or imprisonment. So therefore very important to make sure that everything has been nicely tidied up before it actually goes into the MVL. Another risk is misguided expectations of directors and shareholders on when funds will be released. Even in a case where everything has been tidied up beforehand, that there's going to be a number of weeks before the liquidator can get final clearance letters from the revenue, and to make sure that he is satisfied that that there are no skeletons in the cupboard, so to speak, and that the creditors have been paid. The liquidator will often ask the shareholders to provide him with an indemnity in order to mitigate any potential risk to him. For example, if a creditor does come out of the woodwork that the liquidator wasn't aware of and he's already distributed the funds, then he's got a problem and would be looking to recover the funds from the shareholders, which isn't always easy. The process is relatively straightforward, and of course the liquidator insolvency practitioner will guide the directors and shareholders through it. It starts off with a board meeting of the directors where they will convene a general meeting of the company's shareholders. Notice of that meeting must be sent to all the shareholders and with a minimum of 14 days notice. Notice of the general meeting must also be given to any floating charge holders. The notice periods can be waived by the relevant parties if they wish to do so. Directors also at the board meeting swear a declaration of solvency, which I touched on earlier. That incorporates a statement of the company's assets and liabilities, what we call a statement of affairs. At the general meeting, the shareholders resolve that the company be wound up by special resolution. They pass an ordinary resolution to appoint a liquidator and agree the liquidator's remuneration. And a special resolution is also passed to enable a distribution in specie if it's appropriate. Quorum of the shareholders is required at the meeting. If there's only one shareholder, then that's fine. They would normally attend the meeting. If there's more than one shareholder, a minimum of 2 must be represented at the meeting. Once the liquidator has obtained all the relevant clearance letters from HMRC and is happy to distribute the funds, once those have been correctly apportioned to the shareholders and paid, he may then feel it appropriate to convene the final meeting, in which case he will draft his final report. That is then filed at the Registrar of Companies House, and the registrar will then look to dissolve the company within 3 months. It's important to ensure at that stage that all the assets have been dealt with before dissolution, otherwise they become bona vacantia and will vest in the state. Okay, well, thank you for taking the time to watch this webinar. I hope it's been useful and helpful, giving you an insight into members' voluntary liquidations and when they may be appropriate. At TH Financial Recovery, we provide all our clients with free consultations, and therefore if you do have any questions, wish to arrange a meeting to discuss the process in more detail, please do give us a call.